HSAs or health savings account. Let me ask you this. Should you have one? What is triple tax benefits? Listen to this episode. We have a specialist, a tax strategist, which we're going to talk through all the details. You want to listen to this one all the way to the end.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. Today we are going to be talking about HSAs, and when we talk about anything related to tax benefits or how that might help us or hurt us or whatever, we always bring on our tax strategist, in-house tax strategist, Taylor Wolverton. So before I go any further, Taylor, thank you very much for coming on with us today and having this conversation.
You're welcome.
All right, so let's talk a little bit and give everybody a little bit of an idea of what the day's show is about. So, health savings accounts are something that have been around for a while. One of the things that we've had discussions about is, do people really understand how they work? Do they understand, the benefits of them? What are the restrictions? How do I even be able to get into them? So we're going to kind of go through all of that today. And we're just excited that you come on to help us think all these things through and make sure we understand all the rules. Before we do go much further, though, I do want to make sure everybody understands we are going to be talking about a few different numbers today and guidelines. We will have a blog article that will have all of these numbers in there. So if you're listening to this and you're on a walk or you're in the car, don't worry about that. We'll have all this documented for you. But Merce, you want to get us started in the conversation?
Yeah. So Taylor, what I'd like to do is just get an overview of what an HSA is. Raiden mentioned health savings account, but what does that actually mean to our listeners? And HSA kind of goes hand in hand, or if you read articles about them, you say you don't want to ignore these. They have tremendous tax benefits. So help us understand what is an HSA and what are the tax benefits?
Yeah, HSAs are great because they are the only triple tax-free account available. So triple tax-free, what I mean by that is, for one, the contributions that you make to an HSA are tax-free. Inside of the account, you can invest your contributions, and any growth on those invested contributions is also tax-free. And then if you use the distributions for qualified medical expenses, which we'll talk about a little bit later, the distributions are also tax-free. So contributions, growth, and distributions all tax-free. That's the triple tax advantage. And HSAs are the only account that offer all three. And that's income tax free, but also most HSA plans, kind of just depending on the way that it's written and the way you're making your contributions, most HSA plans are also not subject to FICA tax, which is Social Security and Medicare. 6.2% of all of your earned income goes to Social Security, 1.45% goes to Medicare. So it's also a possibility that not only is it income tax free, but also FICA free as well. So.
Can we just talk about an example just so everybody can catch up here a little bit? Let's just say I want us to walk through a scenario. So put $1,000. I'm making the number really easy. I put $1,000 into my HSA or health savings account. So we're saying that $1,000 is now going in, and I don't have to pay taxes on the $1,000 because it's tax deductible.
Right.
So let's say I leave it in there for a few years and it grows to $2,000. So I did not pay. So leg one is I put it in, I don't pay tax on it. Leg two is I put $1,000 in, it grows to $2,000. I'm not going to pay tax on the growth of the $2,000. And
Correct.
Now the third way I'm going to get tax benefit is how? How do I get it out tax free? What do I have to do? What qualifies for that?
Yeah, so you have to use it for medical expenses, which could be like any copays that you're making. It could be anything that goes towards your deductible or like coinsurance, things like that you can use for medical expenses directly. Any distributions that you use for medical expenses are going to be completely tax-free.
Yeah, so I just wanted to walk us through so everybody gets that, right? So
Yeah.
that's why we're saying triple tax benefit is I can now, because otherwise I could go and let's just say I went and bought something that was approved medically, and I just went and paid that out of my bank account. I've already paid taxes on that money. I now go buy it. I don't get to be able to deduct that medical whatever I bought, the prescription medicine, or well, let's just go with a prescription medicine. I don't deduct that. So I've paid taxes. It didn't grow tax free, and I had to buy it, and it's now not tax deductible. When I use the health savings account, I pretty much was able to get that. I mean, in just a wonderful tax benefit. And I don't think people really understand the power of that triple tax benefit. And I just think it's such a huge benefit. So I don't mean to interrupt. I just want everybody's brains to kind of come around and go, wow, this is amazing
Yeah.
on what we can do here. Sorry, Merce, if I
Yeah, no,
got into this, but
I think that's good, and I think it's nice to point out. My bet, and I don't know that this is actually true. My bet when the HSA was created was it was really for, hey, let us find a way to help you out tax wise in your calendar year to help with your health expenses throughout the year. But as people have learned more about it and become more educated on this triple tax benefit and long-term growth and compounding growth, now it's turned into a bit of a retirement strategy that I think we can talk about as we
Mhm.
close out the episode today. But I think first things first, HSA sounds fantastic. Triple tax benefit sounds incredible. Um, but what makes someone eligible to open up this type of health savings account?
Yeah, the first thing that you need to make sure of is that you have a high deductible health plan. Any other sort of health insurance is not going to qualify to use an HSA, so it has to be high deductible health plan, which right now the minimum deductible if you're an individual on an individual health plan is $1,650, or for a family plan it has to be at least the deductible has to be at least 3,300. So high deductible is important. Obviously, you have to be employed or self-employed to have that health insurance plan connected to that as well. Could be through your employer-sponsored plan, or yeah, like I said, if you're self-employed, you can also go through the marketplace and get a high deductible health plan there as well. And if you are employed, then it's possible you can make contributions through your payroll, just like you would to your 401k. It comes directly out of your paycheck, goes straight into the HSA. Or it's possible you can also open a health savings account on your own and make contributions out of your checking account. The tax benefits all gets reconciled on your tax return at the end of the year. So even though the dollars that go into your checking account, technically you've already paid tax on it, you'll get that tax refunded when you file your tax return. So whichever way makes the most sense and is easiest for you to make those contributions, you can go either way.
so can we talk a little bit about, I know we talked a little bit or just set up here with Medicare. How does that work once a person
Yeah.
gets into Medicare age?
Yeah. So one thing to be aware of, once you are enrolled in Medicare, Part A or Part B, you are no longer eligible to make HSA contributions because Medicare is not a high deductible health plan. So, for one thing as well, if you start Social Security, you're automatically enrolled in Medicare Part A and by default ineligible to make HSA contributions. So, that's one thing to be careful about. If you're starting Social Security, you need to make sure your HSA contributions stop. So, for example, let's say you turn 65 in January of this year and you're employed, you're on a high deductible health plan, you're making contributions to your HSA, and then you plan to enroll in Medicare, let's say in December of this year, you're going to retire, go onto Medicare in December, then you need to stop your HSA contributions actually 6 months prior to when you enroll in Medicare because Part A is retroactive for 6 months. So again, if you're retiring in December, you're 65, you're going to go on Medicare in December, you need to stop your HSA contributions in June, 6 months prior to your Medicare eligibility, to make sure all of that is the way that the IRS needs it to be to give you all of the benefits. So
All right. Well, definitely something to think about as we
yeah.
start to think on transitioning to retirement and how that fits into the plan. What about as far as dollar amounts that you can put in? It seems like everything that has a tax benefit to it usually has a ceiling on how much you can put in.
Yeah.
Like 401k contributions have limits, IRAs have limits. So tell us about the contributions here on the HSA.
Yeah, that's exactly right. So your contribution limit depends on the type of plan that you're enrolled in, individual plan, or if you're on a family plan, those have two different limitations. So first, if you're on an individual health plan just for yourself, the maximum contribution that you can make for 2025 is $4,300. If you're on a family plan, then the maximum HSA contribution you can make in 2025 is $8,550. There is also a catch-up contribution for HSAs. If you're over the age of 55, then you can add an additional $1,000. So if you're over 55 and you're on an individual plan, your maximum contribution is $5,300 for 2025. If you're over 55 and you're on a family plan, then your maximum contribution is $9,550. And those contribution limits are indexed for inflation each year, so they do go up. So make sure you're checking the actual year that it is for those contribution maximums. And one thing too is a lot of employers, if you're on an employer-sponsored plan, they will make contributions to your HSA as well, kind of like a 401k match, similar methodology there. Your employer contributions also count towards that maximum. So if you're on a family plan, you're over 55, the maximum is $9,550. If your employer puts in $2,000 for you, then your remaining contribution is $7,550. So that's a little bit different. Like with 401ks, your employer match does not count towards your individual maximum contribution, but HSAs work a little bit differently. So you need to make sure if there are employer contributions, you're factoring that into that maximum dollar contribution for this year.
All right, excellent. And I, how does this work if I want to put money in? Is it like a 401k or not a 401k, but an IRA where I can put it in after January 1st and apply it to the year prior?
Yes, the deadline for HSA contributions is April 15th, so that aligns with the tax return filing deadline. So yeah, if the end of the year comes and you're, a few months into the next year, you can still make contributions for the prior year up until the April 15th deadline.
Okay, great. So funding it's going to be important, and doing that at the right time, and then definitely the Medicare piece of it too. We don't want to incur
Yeah.
penalties. So let's say we do all that properly, and then that one big tax benefit is on withdrawals. So I know we touched on it earlier, but can we walk through what the qualifying medical expenses are that's going to let us use this money tax free?
Yeah, so anything that you would need to pay out of pocket for like medical related expenses, anything that would count towards your deductible, any co-payments that you have, anything like related to co-insurance payments. If you have Medicare premiums, you can use your HSA to pay your Medicare premiums. Same with long-term care insurance premiums and also COBRA. So not only is it like for the actual service, like health related services or products that you're using, but you can also use it for those premiums for insurance as well.
Yeah, I mean, you think about that. I mean, that's how I think about it. So I fund an HSA, max fund it every year. I've never taken any money out of it because I do look at it and go, hey, if I build this up, I can use it for the other. And although I do have medical expenses, I just don't use it for that because I want it to grow. Because I think in the future, I might even have a bigger expense that it makes more sense for me to say I'm going to utilize that at that point. So that kind of brings us to this next question that I'm going to set up is that what's my long-term benefits? There's certain like medical, I can't remember what it's called, but sometimes you've got the account where within the company and you have to use it every year.
An
Uh-huh.
FSA flex spend?
Yeah,
Flex spending, yeah, flexible spending
exactly.
spending account. So an health savings account, what is my long-term benefits?
Yeah, so like we talked about how you can invest your contributions, that account is yours forever. If you change employers, the HSA follows you. If you change health insurance plans, the HSA is still in existence. So it's never going to be an account that you lose or that you are disqualified for or anything like that. It stays in your name regardless of any other changes related to that. So that is kind of like typical advice being if you have health expenses and you need to use your HSA, that's fine, you can. But if you have other cash or other resources available to cover those medical expenses, then leave your HSA as it is, leave it invested long term, because like you were talking about, Raiden, as you get later into retirement, like eventually you're going to need your HSA, you're going to have medical expenses likely as you get older. So the longer you can leave those dollars invested, growing tax free, available to you for future medical expenses on distributions tax free, then that's only going to benefit you long term over the course of your retirement.
Right. Imagine if you fund this HSA concept for 20, 30 years without touching it, and it makes a decent rate of return, 5, 6, 7%. I mean, that could be pretty powerful over time.
Yeah.
And so what happens if we get to a place where, we're in retirement now and we want to use this money not for qualified medical expenses? What's the issues there, and how does that turn around on us later on?
Yeah, so another unique feature of HSAs is that once you reach age 65, the rules around HSA distributions shift at that point in time. And then the HSA almost becomes like a traditional IRA where you can use your HSA for whatever you want. If you don't have medical expenses, you want to buy a car or whatever it is, you can use your HSA. However, the distributions are still taxable if you're using it for something other than medical expenses. And again, that's only over the age of 65, but still a flexible type of account that can benefit you. If you need to use that, it's available to you. Like I said, you will pay income tax on the distributions if you're not using it for medical expenses, but it is a possibility to incorporate that into your distribution and income planning.
So
The
I just
other
want to
thing,
give everybody
oh yeah,
though.
go ahead.
I just want to give everybody again a visual on this.
Yeah,
So let's pretend that I fund my health savings account, do a very nice job getting money in there. I don't touch it. Then comes 65. When 65 comes, let's say now I'm going to go back to your analogy. I need a car. I'm going to ask this question, rhetorical. Would it really make sense to take money from my health savings account and go buy the car? I'm going to give you a big astounding no, and here's why. What I could say is, well, how much is my Medicare premiums? Let's say that my Medicare premiums between me and my spouse, let's just say, are $500, $600 a month. Let's just whatever it is. I now use my HSA to make my $500 um, uh, Medicare premiums, which now frees me up to go buy a car with a $500 payment, and I got the tax
yeah.
free benefit. So I wouldn't really use that money to go buy the car. I would say I'm going to make these payments over here that frees up money that I was having to pay. I get the tax free benefit. Now I can go buy the car on the side. And it's just that's again, how do I want to make sure I classify the money? I'm obviously going to spend this money as much as possible to get the tax free benefit. So buying the car with the HSA money probably doesn't make sense, but I could free up cash flow. So before somebody
Yeah.
goes out at 65 and says, I want to go spend this money, I think that comes back to let's have a plan. And one of the things that we talk about is, with you, Taylor, we're having tax strategy meetings with our clients every single year. And if a client said, hey, I think I'm going to use my HSA to go buy a car, we'd probably go ding, 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 don't do that. Like stop,
Mhm.
think, and then move forward. Um,
Yeah, the other thing on that topic too is like if you were to be audited for your HSA distributions, it comes down to you need to have the receipts to show that you have those medical expenses. So it doesn't have to be like you take those exact dollars out of your HSA to pay for, whatever happens to be. If you have receipts showing that you've had medical expenses and you take a distribution equal to whatever your receipts are showing, then that's all the evidence that you need to prove that you have medical expenses if you were to be audited for your HSA distribution. So as long as you're keeping good records, you have those receipts, then you're good to go.
Yeah, so I think, right today, I think we don't see a lot of money left in HSAs today, but I think with it becoming such a big retirement planning tool, I think what we are going to have is people that end up having money left over in their HSAs that they weren't able to use. So how does that work then? Someone passes away and let's say they've got 100,000 left in their HSA, does that just disappear?
Yeah, I think this is important to be aware of as well, just so that you can be planning and be using your HSA as needed. So if you're an HSA owner and you pass away, if your spouse is your beneficiary, your spouse can inherit that HSA and keep the same rules for tax-free distributions on medical expenses. But if you pass away and the beneficiary is a non-spouse, anyone other than your spouse, the rule is that they have to take a lump sum distribution, full distribution of that HSA. It's not treated as like your typical HSA rules. All those rules go away. It's a fully taxable lump sum distribution in the year that they inherit the account. So if you are leaving your HSA to your spouse, that's fine. Those benefits continue to your spouse. But if you're leaving your HSA to anyone other than your spouse, then you want to be careful and try to use up your HSA because it's not going to benefit the beneficiary if it's someone other than your spouse. That those tax benefits do not continue beyond you as the account owner. So
Well,
yeah, something to pay attention to.
all right. Well, I think to sum this up is health savings accounts, if we are eligible, make a lot of sense for us to be able to fund, and the benefits there are really, really, really good. So thank you very much, Taylor, for coming on and helping us break this down in such an easy to understand way. And if you have any questions, if you're listening to this, it's easy to get in touch with us. You can just go to our website, pomwealth.net, go to the Contact Us page, and you'll see a way to submit your information to us, and we will be glad to get in touch with you and have a question, answer any of your questions that you might have. You can just call the office as well, which is 919-787-8866. All right, Taylor, thank you so much. We appreciate it.
Yeah, thank you. It was fun.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.